Hi, everyone. Welcome to Market Outlook, Trends, Risk Events, and Trade Setups brought to you by Vantage Markets. This is a weekly webinar where we focus on what's been happening in markets and what is about to happen in the week ahead. Whilst I just let you have a quick look at the disclaimer, I'll just run through what we hope to get through in the next 30 to 40 minutes or so. We'll just check out, as usual, how markets are trading currently. And check out a few of the headlines over the weekend. We'll then get into one of the big events, obviously, of this week, which is Nvidia's earnings. So we'll go into some detail about what's expected and just a broader few thoughts really on what is expected to happen, really, as well as the numbers, as I say. We'll look at the chart as well. So some of the technical levels as well to look out for. And then after that, we'll look at US stocks in general, more broadly, really, with a few interesting other earnings, actually. We have some of the big US retailers reporting this week as well. So it should give us a picture on the US consumer as well, which is of high importance, really. So, we'll just check out that. Then we'll just get into last week's couple of events. We had some UK data and also some Australian jobs data. Which was pretty important, actually, pretty strong, and so helped the Aussie, but really push back any chance of sort of near-term RBA rate cuts. And then after that, we'll get into this week's main events. Of course, we have US non-farm payrolls. Yippee. The sort of first major economic data out of the US after obviously the US shutdown ended and we get the reopening, so we get some data. So we'll just go through that, although it is, of course, September's non-farm payroll, so a little bit dated, but still worth checking out. Of course, we do have the Fed minutes actually as well on Wednesday, before the non-farm payroll report on Thursday, that is, not on Friday, on Thursday, so we'll check that out. And then we have a bunch of inflation data out of the UK, out of Canada, out of Japan as well. So we'll just check out that and the associated currencies. So sterling against the dollar, dollar CAD, and dollar yen. We also have PMI data, actually, so a brief look at that. And then if we get time, hopefully I'll just touch upon what's been happening out of the UK, actually, on the fiscal side, sort of government side and the budget, and a few thoughts on that. So a fair bit to get through. Here's just a rundown of that. I should say, if you do have any questions along the way, please do ask them. Always more than happy to try and answer any question you have, however small, however big. Please do ask that in the chat box. And try and answer that as best we can as we go. Anything I'm talking about, of course, or anything you're looking at, any trade setups or fundamentals, of course, we're more than happy to try and help on that front. Okay, markets currently then. Well, as I said, after weeks of blackout, really, let's get to that. We will finally get long delayed readings on the strength of the US economy. As then now US government agencies resume publishing key indicators, including, of course, employment data. These releases really should offer a clearer guidance on the Fed's policy path. That's what we've all sort of been looking out for the past few weeks. There's been this sort of dearth of data, I've been calling it, and policymakers been flying blind in some ways, just sort of relying on private releases of economic data, which are really much smaller in scale generally, and not as important, not really closely followed compared to the government figures that are put out by the BLS for sure as well. BLS being the Bureau of Labor Statistics, which puts out the non-farm payrolls report. So, really important week for fresh data to come out of the US. And then we have, of course, Nvidia's earnings, which I'll get to shortly. As for headlines over the weekend, we had US Treasury Secretary Bessent. He said China rare earth, rare earth deal, will hopefully be done by Thanksgiving. That is next week. That's according to Fox News. President Trump, said he does not think more tariff rollbacks actually will be necessary. And he said top US officials spoke with their Chinese counterparts on Friday, and that he is speaking to China about soybeans, according to Reuters. So just some trade headlines there, which have been relatively quiet recently. Interestingly, Apple has intensified succession planning for CEO Tim Cook, and is actually preparing for him to step down as soon as next year, according to the FT. And then as for markets, APAC stocks, Asian stocks, they traded mostly lower after the sort of mixed lead from Wall Street on Friday. European equities generally lower, off around 0.5%. The Eurostoxx 50, that's after it closed down 0.9% on Friday. That's 0.9% on Friday. Bitcoin over the weekend actually briefly erased all this year's gains, falling to near 93,000 as crypto markets suffered over the weekend. That's kind of been bought today, actually, and we're above 93,000 now. On Bitcoin, for the dollar, that's modestly bid, and we'll look at this shortly, actually, while gold trades a touch lower, actually pretty flat, touch lower. Actually, for a third day, just above 4,000, 4,080. And there's support, around the 4,000 and 4,024 level, actually, with just the push higher from that to the middle of last week, being hit on Friday of last week, actually, with this diminishing hopes of US Federal Reserve rate cuts next month. And also we'll get to that. Those odds, just for your guide, now around 45% for a 25 basis point rate cut next month. That was more than probably around double, more than double, just under actually a month ago. So that has hit gold recently, and we have had a whole host of Fed officials talking around that, and we'll get to that shortly. Let's now just push forward to NVIDIA first of all. Just got a chart here that you can see NVIDIA relative to the tech sector, and then relative to the S&P 500. Stock up around just under 40%, I think, year to date now. That you can see just under 40%, actually. Whereas tech sector is up sort of mid 20%, and then the S&P up mid 15-14% or so. Year to date, this is. So still outperforming, just a touch really more volatile than it has been on this sort of straight line, that sort of upward move that we've seen, of course, across the last few years. I think there's a big headline going out. It's NVIDIA stock is up close to 1,000% since, I think, sort of late 2022. So you just watch for those headlines, of course, into the run up for their earnings. They come out on Wednesday after the US close. Wednesday 19th. And of course, it's a bellwether. It's a giant, obviously, for AI, for the market in general, really. But of course, it's around that AI market leading status that NVIDIA is now known for. It obviously became the first $5 trillion company last month, and I've shown you this chart before. And though it has lost a bit of that since, it still has, I think, quite a staggering weighting, around an 8% weighting in the S&P 500, double-digit weighting in the NASDAQ. So the clout, of course, for those indices, let alone all other major global indices, really is very high. It has this sway on markets, as I just told you, with the weightings, and that's why it's a big risk event, on a par with, say, a normal non-farm payroll report. Recently, of course, we've had the sort of US-China AI race that's continued to heat up, with worries out of the US and participants, really, that China may be taking the lead. And that was actually echoed by Chairman Huang, who said just last week, actually, that China will win the AI race. So certainly there may be questions around that on the analyst call after the release of the numbers. That said, of course, still huge optimism in Nvidia. Plenty of upside potentially ahead by many. I know Susquehanna, they raised their price target into earnings, citing Huang's recent commentary that the company has secured more than $500 billion worth of orders for its Blackwell and next-gen Rubin chips through 2026. So, and I think other investment banks as well followed suit, raising their price targets on that news. Flip side, though, of course, we had news, if you followed it last week, Michael Burry, sort of big short seller. He's had a big bet against the AI rally with actually 1 million puts, their options basically, where he benefits if the price moves lower. So he's had a big bet against the AI rally. While we did have that news as well on SoftBank, apparently selling its entire stake in the company. Although if you read beyond the headlines, actually that was because they were moving into other parts of AI and taking profits. Expectations then for numbers, Q3 adjusted EPS is forecast at $1.24. That's on revenues of 54.8 billion. And then they're expected to guide to 61.5 to 62 billion for the fourth quarter, with gross margins near 74% for the third quarter and 74.7% in Q4. That's really to satisfy high buy-side expectations. Just on the breakdown, data center, certainly the key revenue driver for Nvidia, expected revenues of 48.3 billion, and then gaming much lower, 4.4 billion, and then automotive 621 million, and professional visualization 611 million. Certainly then sort of TLDR, if you like, high bar, of course, always is a high bar. Jensen Huang expected to deliver a strong outlook, which is what we've essentially become conditioned to see. We've seen in other earnings, just for your guide, of course, all this sort of concern around AI capex, of course, and so questions will be asked about that, I'm sure, and about demand, future demand as well. Obviously, we've seen some companies then get impacted or hit quite badly if then they're deemed to be spending or seen to be spending too much on AI infrastructure, which then there are question marks about future revenues, I guess, from that big investment spend. There will, specifically for Nvidia, be probably investors looking for updates on their target, actually, of an additional 14 million GPUs, as outlined previously, actually. And also, investors will want progress on its $100 billion investment in OpenAI. As I said, reaction will ripple through broader markets, let alone, of course, the AI and semiconductor space. Options, they're pricing a plus or minus 6.5% move on the day after reporting. So the Thursday open is where we want to be watching it, actually. And obviously we'll get the grey markets after the results on Wednesday evening UK time. And yes, we'll get a grey market indication of where the stock is trading, of course, but at the moment, plus or minus 6.5% move on the day after reporting, and that really sets up the platform for, and I think, of an implied move on the S&P 500 of plus or minus 1.1%. So that's sort of a guide on what to expect. Obviously, more broadly, there's this uneasiness around sky-high AI valuations. And still, as well, there's sort of maybe questions about the recent stake reductions from major holders, and that kind of adds to concerns that some of the concerns we've been writing about, actually, in the week ahead, just about this sort of circular capital flows within the AI ecosystem, which may be inflating a bubble. We called it a sort of AI hot potato, if you like, just with CapEx really being sort of handed between just a few names, and that's then becoming this bubble. We just pull up the NVIDIA chart then, first of all. But that is generally what markets are expecting with numbers, and then some of the questions. Just bear with me. And yeah, here's the chart. So you can just see we've just come off that high around 212.19. We touched it a couple of times, really. End of last month and then beginning of this month. And now we're back to trading around the blue line, which is the 50-day moving average. That's at 185.61. We also have, we put in here some fib levels from that low in April, the post-Liberation Day low, really, at 86.62. And the first fib levels are 23.6. So a minor fib level, really, that comes in at 182.56. So around the 50-day moving average as well. So interesting level of support. You can see resistance initially. Well, yeah, we can't say that. Sorry. Just, previously it's sort of capped the upside, interestingly enough, and the downside. So just watch around that zone. Otherwise, the major fib level, 38.2, you can see is at 164.22. And then the halfway point of this move higher, which sort of is very close to the black line, which is a 200-day moving average. That's a 151.19. And then the halfway point of this moves at 149.41. Okay, that's NVIDIA. Otherwise, more broadly, stocks in the US, they closed mixed on Friday, obviously, after a pretty tumultuous week where we saw a decent sell-off, actually, before Friday, really on this reassessment of the odds of a December rate cut. The S&P slipped 0.1%, the Nasdaq gained 0.1%, the Dow fell 0.7%, having risen quite well earlier on last week. Of course, the end of the government shutdown, that removes one's uncertainty, but that does leave some key data releases delayed. Interestingly, on Friday, we saw defensives, which had been performing pretty well. They lagged with, for example, United Health down over 3%, Home Depot down 1.5%. And the market breadth sort of stayed uneven, really, as we still have stretched AI valuations and then those fading rate cut easing hopes, if you like, which kept sort of smaller and weaker names under pressure. That was the US stock market. If we look at the indexes, then the main indices, we've got the S&P 500, first of all. Get rid of that. So you've got the high, all-time high at 69.20. We've got this sort of ascending channel in here, bull channel, and we've just dipped out of it, although we've touched the blue line, which looks like pretty decent support. That's now at 67.04, and we've just closed above it, interestingly enough, and we're sort of just around the bottom of the bull channel, if you like. So interesting if we do dip below, well, decisively below the 50-day moving average, 67.04, that is. Then we've got a couple of fib levels in here, 66.48, minor fib level there, and then 64.79. That's all of this move from the May low up to that record high. So that's the S&P 500. For the Nasdaq, sorry, get rid of this. We've dipped out of that bull channel again, but we're trading around the 50-day moving average. That's at just below 25,000 at 24,895. All-time high, 26,182. And then we've got a fib level, major fib level below, just above 24,000. That is the Nasdaq. And then let's just have a look at the Dow, which made a new high, not like those other two major indices, which are obviously dominated by tech, which got the big sell-off last week. And we made a record high, which I haven't actually amended on my fib, so bear with me 1 second. That record high is at 48,431. Apologies. Probably do. Sorry, let me just stick this in. So you've got the 50-day moving average again, looks like decent support, capped the downside a couple of times. You can see that's now at 46,611. Didn't cap it on Friday, though. So 46,611 is the 50-day. And then you've got a minor fib level below at 45,641. And then just for your guide, again, that record intraday high at least is at 48,431. Okay, moving on then to last week's main events. Just bear with me 1 second. Just some data out of the UK and Australia. Oh, 1 second. Apologies. Yeah, we had labour market data out of both countries. UK labour market data was more dovish than expected. Actually, payrolls declined, marking the steepest drop seen so far alongside September. But the unemployment rate, that rose to 5%, exceeding expectations, while private sector wage growth slowed to 4.2%, which is slightly below the November Bank of England projection. So quite dovish data. And encouraging for doves on the MPC at the Bank of England. Certainly, they're looking for wage growth data to cool, really, and that looks like it is happening now. So that was the labour market data. Aussie data, jobs data, that came in stronger than expected last Thursday. So unemployment, that dipped back to 4.3%. From the 4.5% September blip, really. That was the highest print, 4.5%. Since November 2021. So that looks like a little bit of an outlier now, with that latest number at 4.3%. And then jobs added were 42,000 versus the consensus 20,000 expected gain. So much faster pace. And actually the fastest pace since April, indeed, entirely driven by full-time hiring. And that came after a 12,700 increase in September. So pretty, very strong labour market data. That caused the Aussie to rally as the prospect really of, as I said, actually at the top of the webinar, more RBA easing continues to be delayed. And actually the chances of a May rate cut, 25 basis point cut, actually plunged after the data to around a 1 in 4 chance, 25% chance versus nearly 70% before that job market data release. Kind of a blessing and a curse, really, for the RBA, as you kind of think renewed strength in jobs markets, or in the jobs market, sorry, risks putting upward pressure on prices when inflation has already actually been rising. So interesting data for Australia there. If we just actually look at the Aussie, because I'm not going to preview any other data out of Australia. So let me just grab the Aussie chart. It's a bit sideways, the Aussie, recently. I've previewed it on our daily commentary, actually, and just said we're sort of stuck in a range, a wide range, 64, 66. You can see here, here's sort of 64, 66 just above there. And we have sort of risen above it, but then we've pulled back into this range. So the 200-day average, just for your guide, that's the 64.56, that black line. 50-day 65.57. And then I've got these fib levels in here from that high from last October down to the low in April. So you've got the 61.8 at 65.49, and then the halfway point at 64.27, so just below the 200-day moving average. Probably could play the ranges, really is best at the moment until we get some a decent upside or downside break. Okay, moving on from that to this week's main events. And firstly, we have non-farm payrolls. And here's just a guide to, the headline number, which is the bar, and then the red line is basically the estimated change. And you can just see in the grayed outline, or box, if you like, September, October data. We haven't had, of course, yet. And we will be getting, as I say, the September non-farm payrolls data on Thursday. And interesting, just to note, October we may never get, because that survey data would have to be done now, and essentially would be sort of backward looking, because survey compilers, if you like, would be asking employers about what's been happening over a month ago, and that potentially will not happen. So potentially we won't get that data. Otherwise, we get the September data on Thursday. Estimates then, consensus estimates expect 50,000 jobs to be added on the headline. Unemployment to stay steady at 4.3%, and wage growth as well, average hourly earnings, that is, to stay steady month on month at 0.3%. Interesting, as I say, sort of headline act, really, isn't it? Normally non-farm payrolls, but could see a little bit less market sensitivity really to this, simply because markets will be looking at it's September data, so it's old, and really markets are looking towards probably now the next data release, first Friday of the month. So that will be the 5th of December, I think, which will be the November non-farm payroll release. And then also the CPI data, which is out on the 10th of December, I think. And they come then ahead of the mid-December FOMC meeting. As for this report, well, obviously, jobs growth. There's three questions really. Jobs growth, is the labour market cooling? So watch whether that headline payrolls gain is slowing, and of course, then a weaker number could boost rate cut hopes, while a hot print obviously would push rate cuts further out. Then secondly, wage growth, of course, kind of key for inflation, and that is a focus for Fed policy still. So if average hourly earnings pick up to, say, 0.4, even 0.5%, they stay high, that means there is possibly persistent inflationary pressures from wage growth. And then the flip side, obviously, softer wages support sort of disinflation trend, which really markets want to see, because they want to see rate cuts generally. And then finally, unemployment rate, of course, will be interesting. I know that Fed Chair Powell put some emphasis on this a few months ago. We haven't heard that much from him since, though, about it. But the job market was sort of creaking, really. But now the unemployment rate stabilizing will be of interest. Just on sort of recent Fed speak, if you like. The FOMC recent statement said job gains have slowed this year, and the unemployment rate has edged up but remained low. And more recent indicators are consistent with these developments. That was back in October. Then we have had a couple of Fed officials, obviously speaking, quite a few actually, with some saying there's emerging signs of weakness in the labor market, that the rate cut at the last meeting was partly to help support jobs while still maintaining inflationary pressures. And then others have argued that the weak jobs data reinforces their view. That was Michelle Bowman, and that multiple cuts may be this year. Flip side to that, we have heard from more hawks really just questioning whether we do need a December rate cut. And that's what we saw end of last week, really, with Fed rate cut bets really getting reined in. And as I said, there's now around a 45% chance only of a 25 basis point cut at that December meeting, 55% chance then of the Fed sitting on their hands, essentially. And as I said, over a month ago, or just under a month ago, that chances of a rate cut were around and above actually 90%, 90. So you can see why we have had some movement in markets, of course. Just let's look at the DXY chart then, which is the dollar index against 6 of its major trading partners, with the euro having by far the biggest weighting of around 56% in this index. Just before we get to this, actually, we do also get the FOMC minutes actually out on Wednesday. Focus will be largely on how divided the committee is, and I've sort of touched upon that with the Doves and the Hawks, and how split members were on that decision to cut rates. They did so, if you remember, but it was a hawkish cut, really, if you like, 25 basis point cut, taking the Fed funds rate down to 3.25% to 4%. But there were 2 dissenters, one hawkish, Schmidt, and one dovish, Mirren. But Chair Powell, in his post-decision press conference, said the rate cut, for the rate cut, it was a strong, solid vote, but the different views at the FOMC were about the future. He was actually notably hawkish, really, in the press conference. He emphasized several times that another cut in December is far from assured, and no decision has been made, and had really strongly differing views in the October meeting. Since then, we've had rhetoric, as I said, noticeably differing. And just touching upon that, actually, more specifically, we've had the likes of Logan, Bostic, Hammack, Goolsby, and Collins all advocating to hold rates in December. Daly and Kashkari kind of undecided. And then you've got the sort of prime doves, if you like, Mirren, Waller, really supporting a further reduction. So interesting sort of big differences on the FOMC, and potentially we'll get some color on that out of the minutes on Wednesday. If we look at the dollar chart now, you can just see we've dipped down from having touched that black line, the 200-day moving average. That's at 99.57. We've got this sort of upward trend line, which is short-term upward trend line, really has sort of acted as a little bit of support. And then we've got a long-term cycle low from 2023 at 99.57, and then a minor fib level at 99.51 as well. So just watch out for that. Otherwise, then the blue line's the 50-day moving average. That's below at 98.56. Okay, that's the dollar index. Let's move on to some CPI data now. And I just pull up then this chart, which shows you just headline CPI, services CPI, and core CPI as well in the UK. That data is out on Wednesday, and may get a greater than normal amount of scrutiny, actually, given, again, a clear divide, actually, at the Bank of England between those wanting to ease, obviously, and keep rates on hold. Those wanting to ease, actually, and then others wanting to keep rates on hold. And that has eventually meant, actually, that Governor Bailey potentially has the tie-breaking vote in November. He did have the tie-breaking vote in November, to keep rates unchanged at 4%, but may have that key vote then going forward in December. Just thinking about the Bank of England and the MPC, a significant focus was on CPI, particularly from Governor Bailey. And that means this release and then the November release ahead of the December Bank of England meeting may prove decisive, of course, alongside the budget at the end of this month, it really in determining whether the Bank of England eases or not. For this release, headline year-on-year number is forecast to slip to 3.6% from 3.8%. That's driven primarily by base effects from the 2024 off-gem adjustment. Certainly, though, Bank of England rate cut odds have increased in the last week after that softer labour market data. And also we had a second a soft read, actually, on September's GDP as well. So implied odds now of a 25 basis point cut by the Bank of England next month have increased from around 60% to above 80% now, I think, last time I looked. So yeah, key data release, although just that caveat, we do get one more before then, the December Bank of England meeting. If we look at cable then, so that's sterling against the dollar. Oh, just bear with me 1 second. Yeah, you can see cable here. Sorry, we dipped down below that 38.2 retrace level of this year's move, actually. So big retrace fib level there, 131.40, that is. That capped the downside in August. We traded below it, but now we're trading just above it now. You've got the 200-day moving average, that's at 132.83. And then above that, the 50-day at 133.55. And then a minor fib level at 133.86. If we do lose this sort of 130 level, then you've got the halfway point of this year's move. That's at 129.41. Just for your guide, euro sterling, in case you don't watch this, that hit a multi-month high. Oh, sorry, 1 sec. Multi-month high last week, last seen in sort of April 2023. Just checking that out. We got up to 88.65. You can see that spike, but then now we're moving lower. So interesting whether that is a decisive top or not will be interesting. Yeah, otherwise you've got that previous high that I've got in here that I need to change now, 87.52. If I just push this up then, sorry, to this spike high, which was, as I say, at 88.65, pretty much there. So you've got a minor fib level actually, which is interesting. You can see at 87.18, which tallies with these previous highs as well, and the 50-day moving average at 87.25. So interesting, probably very strong level of zone of support around that in euro sterling. Let's move to Canada CPI. We get that out shortly, actually. In an hour or so. Interesting with, well, the Bank of Canada is at the lower bound of the neutral rate estimate. We know that now. And with the bank really suggesting rates are at the current level, at the around the neutral rate, we really need a big surprise in this inflation data to see the bank resume cutting. Within the latest monetary policy report, the bank noted inflation is expected to drop in October as energy prices decline. That reflects both lower oil prices and reduced refinery margins. Year over year inflation expected to anticipate to rise slightly by January of next year. That's mainly because prices will be compared with those from the same time last year, base effects. And then after January next year, inflation projected to dip below 2% due to lower energy prices and the end of the volatility associated with the GST and HST holiday. Then the Bank of Canada expects inflation to settle around 2% in early 2026. For dollar CAD, you can see we're still in this sort of mild upward ascending channel, really. In the middle of it, actually. So we've got a fib level in here from that high down to the low of this year. Fib level at 140.17, which we're just trading around. Otherwise, those recent highs around 141.40. And then below that fib level, we've got the 200-day and the 50-day, 139.28, 139.56. That's dollar CAD. Moving quickly on to Japanese inflation data that we do get as well. That's out on Thursday. So national core CPI, that's expected to rise to 3% from 2.9. Price hikes likely to be broad-based actually across goods and services, consistent with Tokyo CPI, which is always the sort of leading indicator of the national data. More positive signs of growth and intensifying inflationary pressures could increase the odds of a December rate hike. Interestingly, Governor Ueda, he recently said underlying inflation is gradually accelerating towards the 2% target, supported by resilient consumption and a tight labor market pushing up wages. Flip side, though, is that the finance minister maintained actually that inflation has yet to stably meet the Bank of Japan's goal, signaling limited urgency for a near-term hike. Of course, we also have to consider the new Prime Minister Takaichi's planned fiscal stimulus package and preference for looser monetary policy, which could complicate, of course, this BOJ path towards normalization. For dollar yen, then that's been going higher, really, on Takaichi's fiscal plans, really, and potentially this pushback against any rate hike by the BOJ, as well as rising treasury yields that we've seen because of this pushback against rate cuts in the US. So certainly we've had interest rate differentials narrowing between the US and Japan, exactly because of what I've just said, and that has pushed dollar yen higher. We've had sort of verbal intervention around these levels. 155 to 160 is the key sort of zone, and we've had verbal intervention in recent days, actually last week. So interesting, we're just hovering around this level, 154.81, which is a minor fib level of this move lower. So interesting, looks like bullish consolidation really before a move to the upside. So just watch then louder verbal jawboning, if you like, from MOF officials about the pace really of this move being too much for government officials and the potential for intervention. Otherwise, we haven't got the 50-day. You can see the blue line is much lower, down at 150.89. That is dollar yen. Okay, I said I'd quickly look at PMI data. And just for your guide, if I just pull up euro dollar actually to wrap things off, I do really appreciate you guys being on the call for so long. PMI data, yes, always interesting. Really, we get that on Friday, and certainly there's focus on the euro area, UK and US, really to gain as well a clearer sense of current really growth momentum as leading indicator of the PMI, and they have signaled improving growth across developed markets through most of this year. So just for your guide, Eurozone PMIs, recent survey data has painted a pretty positive picture actually of the state of the economy in early Q4, whilst we actually saw the prior month's composite Eurozone PMI revised up to the highest in almost 2.5 years. That was driven by services sector, while actually manufacturing stabilized around the neutral mark of 50. That said, I should say this sort of upbeat survey data does contrast with poor hard data. By that, I mean weak industrial production and also soft retail sales, which have sort of continued to point to continued, economic fragility. So interesting sort of differences between that soft and hard data, which we've seen in previous months actually as well. Among the major economies, Spain remains the standout performer, really, while Italy and Germany are softer, and France likely lags still. So that's the Eurozone data. As for euro dollar, just pulling this out a little bit. You can see the 50-day moving average, the blue line, that's at 116.56. That has acted as resistance previously, so watch out for that. Then you've got the halfway point of this sort of short-term move higher. That's at 116.55. And then below we have the 61.8 of this move at 115.92, I think it is. That is on euro dollar. Okay, bear with me 1 second. Sorry, just one sec. Just got to pull up. Sorry, bear with me 1 second. And I just pull up the final slide. Which I've showed you peak inflation actually out of the UK. So bear with me 1 second. Sorry, just a malfunction here. Right, there we are. And yeah, final slide, sorry, which is the one I normally show you, which is just to ask you to follow us on social media, please. And again, thank you so much for staying with me for 46 minutes. Really do appreciate you guys being on the call for so long, and really hope that's been helpful to everyone. I don't see any questions actually, so hopefully, yeah, all pretty clear. Lots to look forward to this week, I think. And video, of course, the key standout. And non-farm payroll as well will be an influence on markets for sure. And then, of course, all that CPI data influencing sterling, definitely. Dollar yen, of course, although that will move with treasuries, of course, as well. And then PMIs to wrap up the week, which are always an interesting leading indicator. Okay, we do put out a daily commentary as well on the website after the US close, which looks at all the dollar assets, a look at the day ahead, and also a chart of the day. So do check that out as well. Take care, and we will speak to you same time next week.